In the first quarter of 2026, Ford sold more cars than Tesla did. Not by a small margin either. Ford sold 457,000 vehicles that quarter, nearly 100,000 more than Tesla managed in the same 3 months. And yet, on the stock market, Tesla was worth more than Ford, Toyota, BYD, General Motors, Ferrari, Hyundai, and roughly 30 other car companies, all added together. So here's the question almost nobody can actually answer. How can a company that sells fewer cars than its rivals be worth more than nearly all of them combined? Let's put the actual numbers side by side, because they genuinely don't make sense at first glance. As of July 2026, Tesla carried a market capitalization of roughly $1.423 trillion, while the combined market value of the next 37 largest vehicle and parts manufacturers on Earth, a list that includes Toyota, BYD, Ferrari, General Motors, Ford, and Hyundai, sat at about $1.415 trillion. Tesla, alone, edged out all of them combined. Here's the twist that makes this even stranger. This isn't a case of Tesla simply being the more profitable company, the way you might assume a higher valuation would naturally follow from bigger profits. Toyota reported a net income of roughly $25.45 billion for its most recent fiscal year, while Tesla's full-year net income came in at only about $3.8 billion on a GAAP basis, meaning Toyota made something close to 6 times more actual profit than Tesla did. By almost every traditional measure a car company gets judged on, units sold, profit generated, manufacturing efficiency, Toyota is simply the better business. And yet investors have priced Tesla as though it's worth several Toyotas stacked on top of each other. So what is actually happening here? To understand it, we need to separate two completely different questions that sound similar but aren't. How big is a company right now, versus how big do investors believe a company is going to become? A stock price was never really measuring the first question. It's constantly, restlessly guessing at the second one. Picture two bakeries sitting across the street from each other. One bakery has been running for 30 years, selling the same handful of recipes to the same loyal customers, earning a steady, predictable profit every single year, with almost no chance of that changing significantly anytime soon. The other bakery is brand new, currently selling fewer loaves and earning far less money, but it just announced plans to open a chain of locations across the entire country, launch a delivery robot that could reach millions of new customers, and license its recipes to grocery stores nationwide. If you had to guess which bakery investors would pay a bigger premium for, per dollar of current profit, it's the second one, not because it's currently the better business, but because it represents a bet on becoming something enormously larger than it is today. That's essentially the bet sitting underneath Tesla's valuation. Investors aren't really pricing the cars rolling off the assembly line this quarter. They're pricing a set of much larger, much less certain possibilities layered on top of the car business entirely. The premium reflects bets on autonomous driving, on the Optimus humanoid robot project, and on Tesla's energy storage and generation division, businesses that barely resemble a traditional car company at all. Here's why that distinction matters so much. If Tesla is ultimately just a car company, its valuation looks genuinely difficult to justify next to rivals selling more vehicles at a fraction of the price. But if even a portion of those other bets pays off, if self-driving software becomes a massive, high-margin business layered on top of every car Tesla has ever sold, if humanoid robots become a real product category Tesla dominates early, the current car business becomes almost a rounding error compared to what the company could become. Investors aren't pricing certainty here. They're pricing a range of dramatically different futures, and weighing how much to pay today for a shot at the most optimistic one. This explains something else that confuses a lot of people the first time they hear it. By every conventional manufacturing metric, Toyota is genuinely the better car company, and investors know that. The stock market isn't confused, and it isn't simply irrational. It's making a deliberate choice to price Tesla less like a traditional automaker and more like a technology platform that happens to sell cars as one part of a much bigger story. But here's where this story gets genuinely risky, because betting on an uncertain future doesn't just mean unlimited upside. It also means the price can swing violently based on how believable that future looks from one quarter to the next. Tesla shares fell nearly 29% over the first 7 months of 2026, following an earnings report where profit per share came in far below what analysts had expected, and the company's operating margin compressed down to just 1.4%. That's an extraordinarily thin margin for a company carrying a valuation built on the assumption that it's about to become something far bigger than a car manufacturer. Here's the twist almost nobody expects from a company this large. Tesla's own leadership has openly acknowledged this exact tension. Management has described the current phase of heavy spending as a bridge toward a different kind of business entirely, one where software, artificial intelligence, and fleet-based revenue eventually take over from simple hardware profit as the company's main engine. In other words, even the people running the company are asking investors to be patient with today's thin margins in exchange for a much larger payoff tomorrow, the exact same bet the stock price has already been making for years. This is also why competition matters so much more for Tesla's story than it might for a traditional automaker quietly defending its market share. In global EV sales, a Chinese competitor called BYD actually leads the field with roughly 17% market share worldwide, compared to Tesla's approximately 9%, even though Tesla still dominates inside the United States specifically, holding around 59% of the American EV market. If the entire valuation rests on Tesla being the company that ends up dominating self-driving technology in next-generation vehicles globally, every gain a competitor like BYD makes in markets outside the United States chips away at the size of that eventual prize, regardless of how many Model Ys are sold in any single quarter. So is the market simply wrong about all of this? That's genuinely the wrong question to be asking, because a stock price isn't a fact waiting to be proven true or false in real time. It's closer to a constantly shifting probability, a collective, evolving bet on which version of the future is more likely to actually happen. Sometimes that bet ages brilliantly, rewarding investors who believed early in a transformation everyone else doubted. Sometimes that bet ages painfully, leaving investors holding a valuation built on a future that simply never arrived the way they expected. This exact dynamic has played out before with other companies, long before Tesla existed. In the late 1990s, a wave of internet companies were valued at staggering multiples of their actual revenue, priced entirely on the belief that the internet was about to reshape commerce forever. Some of those bets, on companies that would go on to become Amazon and eBay, turned out to be extraordinarily right. Many others, priced with the exact same optimism, turned out to be built on nothing at all, and collapsed completely once investors stopped believing the story attached to the stock. The difference between those two outcomes wasn't visible in the stock price at the time. It only became visible years later, once the actual businesses either delivered on the bet or didn't. That's the uncomfortable truth sitting underneath every headline about Tesla being worth more than dozens of car companies combined. Nobody, not analysts, not fund managers, not Tesla's own executives, actually knows with certainty which version of this story is about to unfold. What the stock price reflects isn't a verdict. It's an ongoing, constantly recalculating guess, made by millions of investors simultaneously, about how much of Tesla's more ambitious identity, the robots, the self-driving fleet, the energy business, will actually materialize, and how much of it will end up staying exactly what it looks like today, a car company that happens to sell fewer vehicles than Ford. So here's the real lesson hiding underneath this entire comparison. A company's stock price was never simply a scoreboard measuring how big it is right now. It's a running bet on how big investors believe it's about to become, and the gap between those two numbers, current size versus future belief, is exactly where both the biggest fortunes and the biggest disappointments in market history have always come from. So here's a question worth sitting with. If a company can be worth more than 36 of its competitors combined while selling fewer cars and earning a fraction of the profit any one of them makes individually, how much of that valuation do you think is actually about the cars, and how much of it is a bet on a future that hasn't happened yet? Let us know what you think in the comments.